When markets churn, even the most cautious banks can struggle to keep their balance. China Banking Corporation's first quarter of 2026 perfectly illustrated the battle between credit strength and market volatility. On the surface, this was a quarter worth framing. Net income rose by more than 4%. Net interest margins widened, loans and deposits grew, and bad loans remained low. For most investors, these numbers would signal a stalwart lender weathering uncertain times. But beneath the tidy exterior, losses in the bank's treasury operations left a mark. China Bank booked a striking 4.1 billion peso loss from trading, securities, and foreign exchange, larger than the loss a year earlier. This setback was not isolated. It reflected the same market turbulence punishing banks across the sector. If not for its exceptionally clean loan book, the damage would have been sharper. The key difference was credit provisioning. Unlike peers who absorbed heavy expenses, RCBC, Security Bank, and Union Bank each set aside billions for impairment. China Bank reserved just 684 million pesos. For perspective, RCBC's provisions alone outstripped its quarterly profits, while China Bank's remained a footnote beside its earnings. Had China Bank provisioned at the same rate as peers, its profits could have been halved. The stability of its loan portfolio was, in effect, a lifeline. Still, the treasury loss cannot be glossed over. It wiped out gains in service fees and commissions, pushing non-interest income deeply negative. Moreover, China Bank's bond book suffered sharp fair value losses, with FVOCI reserves deteriorating and comprehensive income shrinking to a fraction of prior year gains. These unrealized losses didn't flow through net income, but they weighed on equity and diminished the bank's book value. This duality matters. China Bank outperformed competitors on loan quality and provisioning, but it wasn't immune to market volatility. Its capital ratios remained solid, though both slipped from the previous year. For investors and analysts, the insight is clear. Robust credit performance insulated China Bank from deeper pain, but treasury challenges and securities losses were reminders of the risks lurking beneath headline results. Ultimately, China Bank's quarter was no tale of unblemished strength. It was a study in fortunate asymmetry. While the markets battered its treasury desk, its borrowers, conservative and disciplined, kept the wider storm at bay. In banking, sometimes that's all it takes to turn a turbulent quarter into a respectable one.